Hello, everyone. My name is Aaron Filbeck. I'm a managing director and head of Unify by Kaya here at Kaya Association. And I'm very excited to be talking about the second pillar in this total portfolio approach piece that we published a few months back, which is investing through a factor lens. And this is actually, I think, of all of the four pillars that we introduce in this piece, this is probably one of my favorites because it hits closest to home from some of my practitioner experience before coming to Kaya Association. So before coming to Kaya, I was a portfolio manager, worked for an RIA where I did manager selection, asset allocation, and portfolio construction. And factors quickly became an important part of my process, both from a manager perspective, but also from a total portfolio allocation perspective. So excited to be talking about some of the takeaways and potential future applications for all of you when it comes to factors. So why is this topic important? And I think it is important for a couple of reasons. One, factors in general, and I'll get into defining what those actually mean, can be very helpful in helping you understand what is driving your overall portfolio's returns. And that can be one, just understanding where managers are coming from, how portfolios will move. On one end, on a more extreme end, it can also help you with benchmarking and potentially even replicating parts of your portfolio in a more cheap, tax efficient, if you're a taxable investor, and more targeted manner. And I think that's an important exercise to go through and to test yourself. So when we talk about factors, what we're referring to here are systematic exposures. And there's two levels of systematic exposures that are worth mentioning. They're mentioned in the piece as well. First are macro factors. So this is where we're talking about your portfolio or your asset class exposure to broader economic drivers. So that could be economic growth, it could be inflation, it could be interest rates. Those kind of being the big ones. Credit spreads can be thrown in there as well. But basically, what's going on in the overall kind of macroeconomic environment, and how does your portfolio respond to those different changes in the macro environment, which I think is very relevant, particularly over the past couple of years, where we've seen a lot of assumptions that we held maybe pre-2020 get really reversed and upended. So you had interest rates that changed, you had inflation that changed, economic growth certainly went through a couple of different spouts, fits and starts throughout COVID. So the macro perspective, I think, is an important one to focus on, particularly since as we talk about, asset allocation is really a main driver for a lot of your portfolio's risk and return profiles. The second, which I think is where a lot of the industry has spent a lot of time, particularly on the public market side, but creeping into the private markets, are style factors. So this is really where you're seeing drivers of return at the manager level and stylistic choices, part of their investment process, and decomposing those returns into systematic exposures. So in equities, that might be value investing, momentum investing, quality investing. On fixed income, it might be interest rates and credit spreads, but also some of those styles I mentioned as well. Cheap versus expensive, quality, and so on. So both of those are important from a portfolio perspective, because you're not only creating an asset allocation, but you're also selecting managers most of the time to deliver on those particular outcomes. Why this is important is because focusing on factors really removes the label of a particular fund or a strategy and decomposes it into what's actually going to drive it. And you can do that at a total portfolio level or a total portfolio approach to understand what is driving the overall asset allocation return profile, ignoring and completely agnostic to what the name of the fund is or the asset class that it supposedly invests in. So it allows you to, one, look at your portfolio and say, are there overlapping exposures that I didn't know about? Are there places of the portfolio that are missing? Perhaps I'm underexposed to inflation protection, but I'm overexposed to GDP growth. And so making some of those decisions and having further insight into the overall portfolio can be very, very helpful. It also can be helpful when it comes to sourcing future managers, future strategies, where you can supplement or even diversify against either missing or overlapping exposures. So again, when I was in the industry and responsible for portfolios, I used a lot of factor analysis at both the portfolio level and the manager selection level, and I thought it was very, very helpful, particularly at the overall portfolio level, to get a more of a detailed view of what was going to drive my portfolio. You tend to see those statistics that a 60-40 portfolio, to be very simple, is 90% or so driven by equity risk. Most portfolios, when you think about just a traditional, even a portfolio that has some alternatives in it, but a traditional portfolio is usually dominated by economic growth as kind of their primary factor. So you may have only 60% in equities, but if you have high yield, if you have private equity, you have private credit, there's a lot of factor loads to economic growth. And so you want to think about that depending on where you are in the cycle and what the overall objective of the portfolio is. If you're a more defensive investor, or you have an investor that is prioritizing fixed income, for example, because they're trying to protect capital, maybe have distributions into retirement, having a full factor load to economic growth could be problematic. I mentioned before, it's also helpful in identifying gaps and overlaps, and it's also very helpful when it comes to sourcing. If you notice that your portfolio is loaded to a factor or missing a factor, that should be a priority if you're trying to counterbalance that factor as well. So how should you think about this moving forward in your own portfolios? There's been a lot of work that's been done on the public side of the markets. You saw a lot of smart beta products coming up throughout the 2010s. Factor investing kind of came in vogue and went, but it's still very relevant in the public domain. Private markets is an area where we're starting to see a lot more research and a lot more focus being taken. And I think what's going to be interesting is how those two come together, because there's a lot of overlapping similarities between the public and the private markets. One of the big challenges, though, is data. There's a lot of data. There's a lot of history in the public markets. So it's easier to kind of make some quantitative analysis around the public side of your portfolio. In the private markets, there's less frequent data, usually quarterly marks. There's also not as long of a history of the private markets, and it's very manager driven at the same time. So whereas we have a lot of data on kind of broad-based indices on the public equity market or fixed income market, you're really dealing manager by manager in the private market. So there's a lot of work to be done, but you can still make some more intuitive, maybe qualitative judgment calls if you don't have access to data, and really kind of focus on those drivers: equity being driven by equity risk, credit being driven by credit risk, and so on. So there's a quantitative, qualitative trade-off that occurs there as well. In addition, I think one of the approaches that you can take is just the intuition behind what is driving returns and where you're at in the life cycle. So equity, for example, venture capital is going to be much more sensitive to some of the economic environments, potentially inflation due to costs, and so on. Credit is going to have much more sensitivity to credit spreads, and so on. But I think it's important, even if there's not enough research or enough data that's available at this point, to start thinking through this, because it allows you to kind of move above the labels of the funds themselves, the asset class labels, that might occur. So hopefully you found this helpful as you're venturing into total portfolio approach and reading through this piece. I think there's a lot of applications that can be taken away from the factor perspective I mentioned data, I mentioned the public versus private, but also measurement as well. There's different ways to measure a lot of these different factors. So hopefully that was helpful, and look forward to continuing this conversation around TPA.